this morning. But let's see how things really pan out from here. But let's bring on board a big market voice to understand the fundamentals, where the markets are headed, what's happening with the broader end of the markets, which are not really playing catch up. Dhiraj Relli, MD and CEO of HDFC Securities, joining in this morning. Dhiraj, been a long time. Lovely chatting with you, and we've come a long way, at least on the headline indices front, hitting record highs, etc. But lack of enthusiasm, so to say, given what's happening in the broader end of the markets. Portfolio is not looking all that great. What's your sense? What are you making of this leg of the rally? Would you expect mid caps to play catch up soon? How are you looking at this entire, move in the market?
Good morning. We've seen a time and price correction both in last 1 year. Indian markets have underperformed if we look at the and compare it with the global markets. Relatively, we have been ranked underperformer. I don't remember that in last when we've had such kind of an underperformance, but such was the year last year. And it took almost 289 sessions for markets to get back to the all-time high levels. And portfolios are not looking good, you're right, because most of the investors have gravitated towards the small cap and mid cap. In fact, the more inflows have been seen in the small cap and mid cap funds than the large cap funds. I was looking at the data and I could figure out that in June 2021, there was 18% ownership of Nifty by individual investors, whereas in June 2025, this reduced to just about 7.9%. So, this clearly explains that the individual investors are more skewed towards the small and mid cap investors. Hence, though markets are close to all-time high levels, but portfolios are not looking good. Having said that, mid caps and small caps are not yet out of the woods. I think the valuations are still frothy and in many pockets, and one has to be very, very selective here because there can be a longer price and time correction in the mid cap and small cap.
Okay, place for a longer time price correction in the mid and small cap universe. But if you compare what's happened in terms of earnings, the large cap universe is flattish, but mid cap universe has outperformed in terms of earnings. Going forward, do you expect earnings from large caps to be better in the second half of FY26? And is the stage set for double-digit earnings growth in FY27? Looking at all the factors like the recent GST reforms, growth figures that have just come in, and of course we'll talk about the rate cut trajectory in just a bit. But in terms of earnings, how is it looking?
Q2 earnings were promising. I think top line, bottom line both shown better performance for large caps as well as small and mid cap, more so in the mid cap and small caps. Mid caps were better. So that's where we see some green shoots. Government has taken initiatives on consumption side, whether it comes to the direct access relief and that increase the disposable income, and also we've seen the rationalization of GST slabs. So, in last few years, government was pushing more capex. Hence, we were seeing the more interest in the PSUs and industrials and so on. But in last 6 months or so, we've seen more drive from the government towards consumption. So that should help us to see a better recovery, more broad-based recovery rather than concentrated one. This year, earning growth is looking to be about 9%, and that the quality of earning will improve dramatically in the next year. This year, banks will have a flattish kind of a growth, maybe 1% kind of a earning growth. But next year, banking sector is looking for a high teens kind of a growth. So that's where the quality of earning, if you slice and dice it with the sectors, you will see that the quality of earning in FY27 will be better. We are hoping that we will get close to 15-16% kind of earning growth for Nifty companies. And that's where the valuations are looking reasonable. If we factor the 15-16% kind of growth, we'll have a 20 multiples for the FY27 earnings for Nifty. We'll have to be very selective in the mid cap and small cap because that's where markets have been punishing and rewarding the earnings also, and that trend will continue. Wherever we will see the earning growths will be good, markets will reward those counters, and wherever earning growths will be not up to the expectations, the punishment will be even more severe.
Sure. Okay, in that vein, let's talk about the recent growth figures as well, Dhiraj. What's your reading of the GDP print? Real growth, 8.2%. That's, way above expectations. But take a look at the nominal GDP growth, because that's what flows through to earnings as well, right? 8.7% for this quarter. It's expected to be even lower. So how are you reading into this dichotomy, and how would you expect it to flow through to India Inc. going forward?
I think macros are stable. Growth is looking good only for India. The nominal GDP, if you look at it, we were growing at almost double digits, and now it has come to a high single digit, close to 9% or so. But that's attributed to the low inflation, and that can be due to the deflators. So to that extent, I think it's short-lived. We will not have this kind of a rock bottom CPI print. So it's a matter of a quarter or two, and then we'll see the base will change, and that's where we'll
Okay.
start seeing the better nominal GDP growth. Real GDP growth is a very promising one, good one. I think we should unleash animal spirit. Government has been doing the same. It's up to the now even private sector to also pitch in and do more capex, and we are seeing some green shoots there. And to that extent, I think the overall ecosystem is looking good. One has to clearly wait and watch the how the impact will be on the taxes collection, on the direct taxes as well as indirect taxes. If GST collection continues to robust and direct taxes also remains good, government will get an opportunity to continue to invest in the capex as well as take more welfare measures also. So to that extent, I am not unduly perturbed with the one quarter number here and there for inflation or nominal GDP. I think it's better to read a real GDP number, which is very buoyant and promising. And we should be aspiring to grow at 7% plus minus in real GDP, if not 8%.
Okay, got your point. In that vein, would you be expecting a rate cut by the RBI on Friday, or would you be in the camp that said that perhaps save it for another day?
I think RBI has done commendable job in terms of infusing liquidity and front loading the rate cuts. We've seen 100 basis point rate cut and CRR steep reduction in the CRR also, and it has infused almost 5.6 lakh crore kind of liquidity in the market. It seems that RBI and MPC is more for the growth, so they will ignore the inflation number and maybe going for 25 basis point rate cut, and that's something we are in that camp. And we are also expecting a Fed rate cut of 25 basis point. I think the data suggests that there is a 87% probability of rate cut. Other than Japan, where we
Yeah.
are seeing some kind of a hawkish commentary coming from the central bank, I think we should be looking forward for more dovish comments coming in from most of the central banks.
All right. Yes, of course, Bank of Japan in the week of hot inflation, a rate hike, in fact, is expected from Japan in the month of December. But let's talk about the currency as well. It's been in a free fall. Second such instance yesterday when we saw the rupee sliding quite sharply. 90 to the dollar is very close now. Do you expect that to come by pretty soon? And how should really investors take the rupee fall into account while building portfolios?
It seems RBI is more comfortable with the wider volatility. They are not intervening and letting the rupee to settle at a fair value. So to that extent, I think in the short term, we may see some more dip in the rupee, and it can touch 90. It was almost there. I think 89, 85 almost was the low today morning. So to that extent, 90 is not very far. But in the mid to long term, I believe that the era of sustained rupee depreciation is going to end soon, and we will probably head towards the rupee appreciation. I think you should read this number with from two angles. One, that it make exports competitive for us. We don't have a significant issues on a crude oil prices, so we can navigate higher imports even if there is a slight increase in the crude prices. So to that extent, it is friendly for the exporters, and we are looking forward for a big boost for exporters. Government also announced some measures on the supporting the exporters, and tariff deal is also on the anvil. The US, United States remains the largest export partner for us. So we are hoping that this deal should come through sooner than later. US has done deals with UK on pharma side, and also did some more arrangement with the South Korea. So to that extent, they are looking to be more amenable and more looking for forward to ensure that there are deals with various countries. India is one large country where they haven't yet come to the terms, and my take is that it's only a matter of time. We'll see that. So also rupee depreciation, you'll have to appreciate the from the point of view of the FPIs also. We've all been worried about and been slightly negative in terms of our narrative about why FPIs are taking out money from India. But if you look at it, the relative performance wise, if S&P gives you almost 16% return, S&P 500, and Nasdaq gives you a 21% return, Hang Seng gives you a 29% return, and Indian markets will give you 9% returns with 4 to 5% rupee depreciation, then they are better off in investing in the other markets. Unlike domestic liquidity, which is married to the Indian opportunities, foreign portfolio investors are not married to the one particular emerging market or few particular emerging markets. They look at the opportunities all over the world, and wherever they feel the risk reward is favorable, that's where they invest. So to that extent, I think their move have been good. But good thing for us at the domestic market is that we have had robust inflows from coming in from the in the form of SIPs and flows in NFOs, and also domestic institutions like insurers have really been providing enough and more stability in that market. So in sum and substance, what I'm trying to say is that earning growths are looking good. Visibility is better. FY27 earning growth will be 15-16%, and also the quality of earnings will improve. Macros are looking better. Crude prices looking in check, and also interest rate scenarios is looking more easing out. So to that extent, if we take all these factors, culmination of all these factors are painting a good picture for the markets as well. And last but not the least, there were flows in the metals, and we've seen the gold and silver going to the roof. If we see some kind of a stability in the gold and silver, the flows that were going to the metals will also sooner than later start flowing into the equities. So I see a good 18 months ahead of us in terms of equity markets.
Sure, good 18 months ahead, and you've touched upon quite a few factors. Of course, the fact that a US Commerce Secretary has confirmed that tariffs on Korea Auto, in fact, has been lowered to 15%, gives us hope as well. You touched upon the metal universe as well, right? Metals as a pocket stood like a pillar even when we were going down somewhere around August or so. Would you see metals as a good play right now then, where one can look for alpha in 2026?
Looks difficult because they are almost at our all-time high levels. So one cannot expect the kind of returns we have got in last 1 year, 50-60% kind of returns in the silver and gold. So my take is that one should take a little bit easy here and not go overboard. I see many investors are, uh, entering the metal space when they are at peak, and there could be a sustained, price correction, or even, time correction in the metals also. But having said that, what strategy that works for most of the investors is asset allocation strategy. To that extent, I believe, having fair allocation to the metals for the long term, 2 to 5% is a good idea in your portfolio. Our learning in last 20 odd year is that, nothing beats the asset allocation. So all investors should look at their risk appetite, their horizon, and arrive at asset allocation and continue to rebalance their asset allocation. I think that will help them to do well. In the interest rate scenario going downwards, even some of the debt instruments will also do well for them.
No, but I was talking about metals from the equity perspective. There is non-ferrous, there is ferrous. With respect to steel, we are awaiting the safeguard duty. But, given the fact that copper, silver have been hitting record highs, we've seen some of the stocks like Hindustan Copper, Hindustan Zinc doing well. So metal stocks, in terms of the metal stocks, how would you approach this segment? Would you look at the non-ferrous ones, ferrous ones, any particular segment that's catching your fancy?
I think there are better opportunities in the beaten down sectors like IT. IT is 15% down in last 1 year. Banks have also not done well, and the earning growth is more coming in the banking space. So to that extent, I think those are better opportunities. Metals are priced to the perfection, and it's a global play, and it's hard to predict what will happen, what kind of demand and supply equation will play out there. So I would recommend that investors should look at from a 18 months horizon, start investing into the IT stocks and banking sector, and also the asset management companies are fairly good play. Some of the new IPOs that are coming are also interesting IPOs, and one can start looking at exposures, taking exposure in some of these areas selectively. Consumption is another space which we believe is on the cusp of improving. And last few years, we've seen only premiumization theme playing out for the FMCG companies or even for durable space. They have been struggling with the volume growth. We are seeing some improvement in the rural demand after this GST rationalization. And we believe that with the increase in disposable income, lower inflation, consumption, and low cost discretionary space are better sectors than metals.
Okay, got your point. Those are some of the ideas for 2026. But last question really. Can't let you go without getting your thoughts on the IPO frenzy. We've seen a host of consumer tech names, solar power names making a beeline for the Lal Street, and a lot has been spoken about the valuations as well. Where are you on that front? Do you think these businesses, commanding such premium valuations, does it merit having, looking at them right now, or would you wait for things to settle down, companies to turn profitable and then make an entry?
The silver lining in this whole primary market boom is that we could able to give exit to the lot of private equity and private investors. So to that extent, it's been good. It also paved opportunities for the domestic institutions to selectively look at the newer opportunities, because they were getting flows in the mid caps and small caps and were short of ideas where to invest in. So that's the silver lining of the IPOs. The short answer to this euphoria in IPO is that investors need to be very, very selective here. Not all IPOs will do well. So do not assume that IPOs will give you a listing gain. And we've seen only 60% of the IPOs have given listing gains. And post-listing also, some of them have really performed well, but many of them have tanked more than 50% since the listing also. So it's a double-edged sword. One has to be very careful and selective in looking at the IPOs. I think investors are better off to see 1 or 2 quarter results and then take their bet on these companies.
All right, that's the call then. Wait for a couple of quarters, see how things pan out, and perhaps then look at these companies. But with that, Dhiraj, would like to thank you for taking your time and joining in this morning, sharing your thoughts. Always a pleasure, and look forward to our next interaction as well. Hopefully this happens this year itself, sometime in the last week of December. But good to chat with you, and we'll see you soon. Thanks a lot.
Thank you. Thank you very much.
Thank you. Well, on that note, take a look at the market. In fact, I think as Dhiraj was mentioning, the rupee in fact came close to that 79, 78, 80 kind of level. So yes, we seen rupee sliding further, and that's kind of weighing in on sentiment on the last street today as well. It's FNO expiry day as well, so we are seeing a 93-point cut on the index. We've slipped below that 26,100 mark. The mid cap index, although, is clutching on to that green zone, barely managing to eke out some gains, but the advance decline ratio has worsened further. It's 1:2 now. So 869 advances to 1719 declines. So not looking very good when it comes to the breadth. And in terms of sectors as well, just want to point out that barring the PSU bank index that's clocking in gains of almost 1%, all the other sectors are trading in the red. Led by the nifty financial services index that's down 0.7%. Metals are down. IT has also slipped into the red. Pharma is down. Real estate, that has been on the back foot, on wobbly ground, is continuing to see losses in trade. But of course, let's see how things pan out, because right now, not really turning out to be such a great day. But let's see what second half holds for us, because it's expiry, so there will be a fair bit of volatility as well. But I'll see you then at 3 p.m. with closing bell. Don't forget to tune in for that. But till then, you guys stay tuned to Money Control, and have a great day. Thanks a lot for tuning in.